The Atlanta Fed is projecting a 2.4% growth in Q2 2025, up from Q1's negative growth, signaling a potential economic recovery. However, complicating things are higher inflation expectations as well as growing trade policy uncertainty, creating a challenging environment for businesses and policymakers alike. Our next guest today will help us understand how these elements interact and what they might mean for economic performance in the months ahead. He is Patrick Higgins, the creator of the GDPNow forecasting model from the Atlanta Fed, and he is the economist and policy advisor at the Federal Reserve Bank of Atlanta. His expertise spans monetary policy, economic forecasting, and statistical modeling, making him uniquely positioned to be talking about our topics today. Welcome to the show, Patrick. Excited to get your forecast.
Yeah, thank you, David.
So like I mentioned in the introduction, Q1 was negative for GDP growth, while the Atlanta Fed GDPNow forecast, which is a forecasting tool predicting the future of GDP for the next quarter, is now positive. So it went from negative to positive 2.4 in just a matter of weeks. What contributed to this development and change and positive outlook?
Yeah, so I should just say that the views I express here are my own and not anybody else's in the Federal Reserve System, including our president, Raphael Bostic. So I would say most of this recovery is essentially sort of there was a large drag from net exports in the first quarter. And so the model doesn't have as large a drag essentially in the second quarter. And that's kind of, it's forecasting relatively strong consumer spending growth based primarily on the March reading. And so I would say that those are probably the two main factors why there's a rebound.
Do you think first quarter's reading was indicative of imports, net negative for imports? So when that recovers, we have a positive reading now in Q2, but it wasn't really, the beginning of a massive economic slowdown, as some people may have suggested.
Yeah, I mean, theoretically, the imports, especially anything you import, should show up in one of the other subcomponents. And so even if the imports, as imports rise, essentially, that's a subtraction from GDP, but other things should be kind of offsetting that, like consumer spending or investment. But those the actual way they assemble, those data are assembled could be challenging in terms of those things might not exactly cancel out. And so in the first quarter, essentially, net exports subtracted almost around 5 percentage points from growth, essentially. And so even if it subtracts something like a percentage point, that's going to be relative to that -5, it's going to be not nearly as big a drag, essentially. And so unless other things come down, then you're going to get a stronger forecast, essentially, than what you had in the first quarter as kind of a published actual result.
I recall that for most of the beginning of the year, as I was following the Atlanta Fed GDPNow tracker, it had projected negative growth for the quarter. And as we actually got the results, advanced Q1 estimates were indeed negative. So the predictive power of the model was quite strong. What were the main components for Q1 that brought your estimate down to negative territory all the way back to January, Pat? In February, actually, was the first time I think I saw it.
Yeah, so it also had a large drag from net exports. There was some kind of technical issues with it related to gold imports that kind of made the top line GDPNow model even more negative than if you had adjusted for those gold imports correctly, which we fixed for this quarter, essentially. The model also didn't have inventories adding as much. So a lot of those imports were showing up in inventories, essentially, but they didn't actually necessarily show up in the Census Bureau data, especially for some technical like wholesale trade. Inventories didn't go up as much in kind of the Census Bureau data as they did in the BEA data, essentially. And so that was kind of the primary component. GDPNow didn't have inventories rising as much as kind of the official BEA number and the kind of Q1 GDP report did, essentially. But kind of qualitatively, it was fairly similar. Net exports were also a drag in GDPNow's forecast, and kind of the other subcomponents were not, apart from the inventories, they weren't kind of off by large amounts, or at least not by kind of historically large amounts.
So let's go back to the website and take a look at this chart here. The Atlanta Fed GDP now estimate is slightly higher than the Bluechip consensus. First of all, what is the Bluechip consensus and why do we have that on the chart?
Yeah, so the Bluechip consensus is essentially an average of 40 business economists forecasts, or they're primarily, I would say, business economists. And the range there is, if you took kind of the top of the range would be the average of the top 10 of those forecasters forecasts, and the bottom of that range would be the average of the bottom 10 of those forecasts. So the range and the consensus there are kind of like a reality check on the model. You can think of it like that. And so when the model forecast is kind of within the range, then it's not a large outlier in some sense relative to what other forecasters are looking at, but it is somewhat above the consensus. So this would be, more optimistic on average than the average Bluechip forecast, essentially. But it wouldn't be the highest of those 40 forecasts. It would be towards the upper end, but not outside of the range of all the forecasts.
What usually is the discrepancy between the consensus and the Atlanta Fed estimate? Is it 1 to 2% below that, or is it usually pretty close?
I would say this is probably, I would say if once you kind of start at the beginning of the quarter, the discrepancy is probably larger than it is towards the end of the quarter. So something like a percentage point now is probably not, it's probably a typical difference. So some quarters it's higher than that, some quarters it's lower than that. As it gets kind of closer to the release, it tends to converge at least closer, but there can still be differences. Even at the very end of the quarter.
I'd like to take a minute now to talk to you about a great way to buy physical gold through a trusted dealer. Our sponsor today, One Gold. Launched by trusted industry leaders in AppMex and Sprott, One Gold allows you to own vaulted gold, silver, and platinum in your choice of secure vaults around the world. With One Gold, your holdings are fully insured, audited, and IRA eligible. One Gold is an intuitive and secure alternative to precious metals ETFs and offers an array of unique investment tools like the Bullion Card, Auto Invest, limit orders, and more. Thousands of customers are using One Gold as a complement to their physical assets using their regular at-spot promotions. Additionally, One Gold offers unparalleled liquidity with same or next day cash withdrawals, 24/7 trading, and physical redemption. Get started today with a few clicks from onegold.com, link down below, or scan the QR code here, or by downloading the One Gold mobile app in the Google Play or App Stores. Why do you think then that the consensus from business economists are a little bit lower in terms of growth than the Atlanta Feds?
They do have subcomponent forecasts of these things. So, and a lot of this is kind of, again, inventories and net exports, essentially. And so there's probably more of a subtraction in those subcomponents as well. And then there's also consumer spending and business fixed investment is somewhat stronger in GDP now than it is for the professional economists. I guess the sort of items in the news that the model's not seeing, in some sense, those might be factoring into the professional forecasts that in the same way they're not being shown. And the model's essentially just taking kind of the hard data and using that to infer its forecast, essentially. And so they might be anticipating things that are going to happen with that data that the model is not seeing yet, in some sense.
I think people are just wondering whether or not you or your colleagues are projecting a recession for this year. Can you comment on that?
I can't say anything beyond kind of what the model is saying. In some sense, obviously the model is not forecasting a recession. I would say even professional forecasters, those numbers are still positive. If you kind of look at the odds of a negative quarter in the survey of professional forecasters, it's less than 50%, but it's higher than it probably typically is. So I can't say too much beyond that. Other than the model is probably not going to forecast a recession until kind of the data turns south in some sense. So it would take kind of getting kind of negative employment numbers or kind of the ISM surveys coming in with really weak numbers for the model to predict a recession. something like equity markets turning down, the model's not going to use that to, lower its projections.
Does the model actually take into account the unemployment rate?
It takes into account data from that survey. From the unemployment rate is one of the things that it takes into that into. So when it gets kind of the data from the employment report, it filters that and uses that to adjust its forecast to the data that hasn't been released yet. And so the unemployment rate is kind of one of those things in there, but there's also a lot of jobs growth and things like that that also factor in. And those kind of the payroll employment industry level numbers are probably, there's more of those numbers in the unemployment rate related numbers in that survey or in that report.
If we break down the components of the Atlanta Fed GDPNow estimates, I think the worst component here in terms of numbers is housing starts, import export prices. You have negative 3% growth on residential investment and housing. Is this a temporary shift, or do you see this as a structural shift in housing that may negatively impact growth beyond Q2?
I would say that number is just kind of taking in the housing starts, the data point, which was kind of below what the model infer for that. And I would also say that those numbers are not anything kind of within -5% given the volatility in that residential investment is not kind of a big contributor in either direction. And so something like that is just, saying something close to zero is probably so the model's not going to probably do it's much better at kind of picking up the data that's already been released and using that to estimate the residential investment forecast kind of once it has all the data, but its forecast might not be right, given that there's multiple months yet to be released, essentially.
Do you agree with the follower's statement that forecasting GDP growth is more of an art than a science?
I would say there are elements of both of those things, especially when you get the further away your forecast is from coming in, probably there's more art elements and science elements. Once you're kind of close to the data point, then it is more cranking in the numbers and, relating those to actually adding things up, essentially. And so there's probably more, at least statistics in that approach. But the model's forecast is all essentially science in the sense that has no judgment imposed at all, essentially. And so I would say professional forecasters probably use more judgment in terms of their further out projections at their near-term forecast, generally speaking.
So just to be clear, is the model only projecting one quarter out, or does it go beyond the next quarter?
No, it essentially takes kind of the subcomponent forecast or the actual outturns for the GDP from the last quarter and the subcomponents from the last quarter, and that's kind of one of the ingredients it uses for its forecast. And so it's only going to go out until the next quarter that hasn't been published yet.
Well, tell us about the genesis of this forecasting tool, how you came about creating it, what was the inspiration behind creating it, and kind of how you took the GDP components and weighted it. What was the methodology there?
Yeah, so I guess the Federal Reserve System started publishing quarterly forecasts around 2007 and 8, I think. And so those are called the formal name, something like the Summary of Economic Projections, essentially, that has GDP as one of the elements that the presidents and the governors forecast, essentially. And so the model was just kind of one ingredient of kind of something to look at in terms of what are kind of statistical models telling us in some sense. And so that started around 2011, I think, and essentially just from kind of sort of professional interest in forecasting and as an input into kind of that forecasting process. It took around 2 or 3 years essentially to kind of get enough data points under it to kind of build up enough history so we had some confidence that it was going to be at least reasonably decent forecast. And so since 2014, we've been publishing this essentially continuously.
How would you say this tool impacts decisions at the FOMC? Do you think members of the FOMC use this tool in their policy decisions?
Yeah, I can't say any. I'm not even sure if I know. Essentially, I know people look at it, but in terms of, I mean, it it is just kind of a statistical models forecast. So anybody that looks at it is kind of free to use it any way, which way they want to, essentially. And so, but I can't say anything beyond that, essentially.
I understand. Well, tell us about the changes that the model has seen over the past years, and essentially, what were the earlier, or what were some of the more significant adjustments that you've made in recent times?
Yeah, I would say for most of the adjustments are kind of minor. So one something like I think around 2015 or 16, the GDP had something like intellectual property products investment was introduced as like a larger subcomponent. So that's like the research and development used to not be in kind of the GDP statistics, but it was incorporated around there around 2016, I want to say. And so things like that were added. And then with the kind of pandemic, there were some fixes there just in terms of kind of the volatility of the data. Kind of some things needed to be changed around 2020 or 2021. I would say those are the biggest items. And the most recent one, like I mentioned earlier, is something with like gold imports, where so much larger, the model had been kind of ignoring them before the first quarter, for this first quarter, but essentially they were so large, essentially they distorted the forecast for net exports in some sense. So things like that. But I would say structurally, the model's not all that different than it was 10 years ago, even.
How do you decide on which data sources to use for your inputs?
So there is a methodology handbook that the BEA, the Bureau of Economic Analysis, the source agency for GDP, they actually publish what the data inputs for each of the GDP subcomponents. So think consumer spending, essentially. So that they essentially will tell you how that's estimated. A lot of that data is with retail sales for the goods part. And so the model is going to try to use that data in the same way that the Bureau of Economic Analysis is when they actually estimate GDP. And so the sources are, for what published, the model's going to use a lot of that same data. There are some things that are not going to be available to the public. So the model is not going to use those in some sense and, use other methods to forecast those.
Okay. At the last FOMC meeting a couple of weeks ago, Chair Jerome Powell was questioned by reporters about the discrepancy between hard data and soft data. The reporter stressed that some soft data sources, including surveys, are indicating slowdown and concerns about slowdown, while hard data may be more lagging, showing more growth and positive outlooks.
Courtney Brown from Axios. I guess, we talked about some of the indications of potential layoffs, price hikes, an economic slowdown, all being evident in the soft data. I'm curious why the Fed needs to wait for that to translate into hard data to, make any type of monetary policy decision, especially if the hard data is not as timely or might be warped by tariff-related effects. Are you worried that the soft data might be some sort of false warning?
No, I mean, look at the state of the economy. The labor market is solid, inflation is low. We can afford to be patient as things unfold. There's no real cost to our waiting at this point. Also, the sense of it is we're not sure what the right thing will be. There should be some increase in inflation. There should be some increase in unemployment. Those call for different responses. And so until we know, potentially call for different responses. And so, until we know more, we have the ability to wait and see. And it seems to be a pretty clear decision. Everyone on the committee supported waiting. And so that's why we're waiting.
Just a very quick follow-up. There was this sort of vibe session, if you will, where the sentiments expressed in soft data did not translate into the hard economic data. How are you thinking about that when interpreting some of the signs in the softer survey data?
I think going back a number of years, the link between sentiment data and consumer spending has been weak. It's not been a strong link at all. On the other hand, we haven't had a move of this, speed and size. So it wouldn't be the case that we're looking at this and just completely dismissing it. But it's another reason to wait and see. You're right, though. We had a couple of years during the pandemic where people were saying just very downbeat surveys and going out and spending money. So that can happen, and that may happen to some degree here. We just don't know. This is an outsized change in sentiment, though, and so none of us is looking at this and saying that we're sure one way or the other. We're not.
How do you reconcile hard data versus soft data, and how do you decide which to use?
So the soft data is used to forecast the source data for GDP that hasn't been released yet, essentially. And so it tends to play a larger role at the beginning of the forecast cycle when there's more data points to be forecast. Essentially, once you're really close to kind of the date that GDP is actually going to be published, it plays a pretty small role. I mean, there's only maybe for that last month of the quarter, there might be a couple subcomponents that you need to forecast that. But then, I mean, at that point, it doesn't really play much of a role at all, essentially. But now it is going to be forecasting data for the soft data will inform the model's forecast for May data and June data that really hasn't been released yet or is in the future, essentially. And so if the soft data comes in kind of softer than the model's expecting, then it can be responsible for kind of a downgrade in the model's forecast. So, recently when things like the ISM manufacturing index or even the consumer sentiment surveys have been weaker, the model forecasts have kind of come down. When the employment report numbers have been stronger, the model forecasts have gone up. That's played out the last 2 months, I think.
Can we comment on inflation expectations now, Patrick? So this is from the Atlanta Fed Business Inflation Expectations model. Year ahead has jumped up from 2.5 to 2.8%. The trough at the end of the year in 2024 was only at 2%. What has contributed to this rise in higher inflation expectations over the last couple of months, Patrick? And should we be concerned about this trend continuing?
Yeah, I can't say too much about this because it's kind of out of my wheelhouse. I will say that is like a survey data essentially, so it is kind of capturing what business respondents are saying, but I can't say too much beyond that.
Does your GDPNow forecast model incorporate inflation expectations?
I would say it plays a very, very minor role. The one role it does play is that a lot of the nominal spending data needs to be deflated, essentially.
Yes.
So something like retail sales, you need to use data from the CPI report to deflate that. But it is the case that the spending data almost always comes out after the price data in some sense. So when the retail sales came out, you already had the CPI data in hand, and so there wasn't a need to kind of forecast that data point. It does do some forecasting beyond it, but it plays a very limited role, and so inflation expectations aren't going to really matter for the model in terms of how its forecast is assembled.
I understand.
But it does need the price data to estimate, convert data from nominal to real. And so that is important.
There was a blog post written by the Atlanta Fed on May 15th, which indicated that 40% of business executives plan to scale back hiring due to policy uncertainty, with tariffs being one of the top concerns. Does the Atlanta Fed modeling the potential impact of these hiring decisions play an overall role in the forecasting of GDP for the next quarter?
In terms of the model, it will pick up things in like the ISM survey. So if those things are kind of common to each other, then it would adjust the forecast in some sense. And so it could play a role there, although I can't kind of say how much of a role, but that's only kind of one small part of it. And so things that's picking up that's not included in the ISM survey the ISM survey is not going to be kind of a huge mover of the forecast after kind of the employment data is picked up. So it's not going to use anything, data points like that or in a large way, essentially, beyond that.
The same research shows that businesses plan to slow down hiring by 13% and scale back investment by 16% during the next 6 months. Do you look at a stat like that? And well, obviously, this is a projection. This is a survey. It's a sentiment by businesses conducting the survey. Do you look at that and actually factor that into growth projections and use that in the model?
No, I mean, like I said, I guess with the ISM data, it doesn't use that in some sense. It needs kind of like a fairly long history in terms of kind of surveys. That survey is probably not long enough in some sense to
Okay.
have kind of a relationship of, that you can go back in time and kind of say, how will this data affect certain subcomponents, or more generally, kind of what this larger, something like the Chicago Fed National Activity Index in some sense. But it does, like the soft data, does have things kind of related to that. So it does use the ISM data. It does use consumer sentiment and confidence data. And so it will capture things like that within the models, but not anything beyond that.
Generally speaking, how much predictive power do surveys have in actually, predicting the outcome of that particular survey? So, for example, I'm just going to go back to the previous example of businesses slowing down hiring. That's what they plan to do. In your past experience, when you look at stats like that, does it actually end up being reflected in the hard data some months later?
I want to say that there are things like you can use that have some predictive power. I mean, I don't want to say too much more than
Sure.
that, but there definitely have been studies that have used surveys like this and kind of improved forecasts. But I would say forecasting is always hard, and so even when you add those elements, the improvement's not going to be probably that much greater than you would get by just kind of looking at the past historical data and extrapolating from that. But sure, I wouldn't disagree that there are things like that a forecaster could use that might make the forecast at least somewhat more accurate, and that might be the best you can do, essentially.
Finally, does your model incorporate changes in financial markets? For example, if we have a big change in the S&P 500 up or down in either direction, is that something you would look at as an input?
It does use, I think it does use the S&P 500 as kind of one data element. There's maybe something like 125 series that use the kind of averages those things together. But that's only kind of one out of 125. So it plays a pretty small role.
What's
I would kind of put it in.
theoretical rationale? What's the theoretical rationale of using, even though it's a small component, but is there any relationship fundamentally between what the markets are doing and whether or not that will have an impact on the real economy? Whereas usually the reverse, where the real economy impacts financial markets.
I mean, I would say in kind of the statistical literature, there is some impact, certainly. But there are other things that have, stronger impacts, or at least as strong. And so, I mean, I would say that this is, in my kind of experience, forecasters trying to use something like that maybe have some modest improvements, but it's still, the forecasting is still going to be hard, even with those things factored in, essentially.
Okay, so then I guess my final question would be, in your current GDPNow model, are there certain variables that have a higher level of importance or weighting currently?
I would say kind of the volatility from inventories and net exports. They were quite large last quarter. And so there are probably reasons to believe they could be large this quarter. And so there might be uncertainty from those subcomponents, and more like goods related subcomponents are probably all somewhat larger in terms of their volatility and their impact on the forecast relative to services, say, than the usual.
Does the weighting of the components change over time in the model?
It does change. It does. Changes are pretty slow. So consumer spendings will kind of size in the aggregate computation is going to be something like 2/3 to 70%. And so that might move like a percentage point or two in either direction in a quarter. I mean, that would be a very big movement, but generally the movements are pretty small from quarter to quarter. And so whatever you used past quarter is pretty good approximation of what you would use this quarter.
Thank you very much. I appreciate it. Where can we learn more from your work and the GDPNow forecast model?
Yeah, I would say the Atlanta Fed webpage, and then there's a GDPNow page. So that's in the Center for Quantitative Economic Research. I think it's called the CQER page. But if you just did a Google search and put in GDPNow, you're probably going to get the homepage for GDPNow, and that's going to have most of the documentation for the model and kind of the written work related to the model on the page. And there's also going to be something called Macro Blog, which will have some recent blog entries about how how the model performed kind of last quarter and the outlook for this quarter. It'll have some details on those that two pieces I wrote fairly recently. You can see those on the macro blog page.
We'll put the links down below. So check out those links and the Atlanta Fed's work and Patrick's work. Thank you very much, Pat. We'll speak again soon, hopefully. Appreciate your time and appreciate you educating us today.
Okay. Thank you, David.
Thank you for watching. Don't forget to like and subscribe.